Hi, Professor. Thank you for doing this with us. So, the course has been actually a blast and it has definitely piqued the interest of many of our students at BITSoM into finance. And it's been a privilege to have this conversation with you where we will be discussing how what we learned in class can be applied to the global markets as of now. So, I would like to start with how our course started. Our course started with cost of capital, and you talked a lot about how cost of equity is higher than the cost of debt, and that's pretty much prevalent in the market. But in the current year, like European Union has been pushing interest rates, and Fed is also doing the same as of now also. So, how do you think? Like, what are the key impediments to firms when they want to reduce their cost of capital in these times like that?
So first of all, thank you for having me, and it's a great pleasure teaching at BITSoM with such an inquisitive group of minds, including yours, and keep that up. It's a great fun to be here and teaching. Now, going back to the cost of capital, I presume you're asking from the perspective of Indian firms and how we could potentially reduce the cost of capital. So, cost of capital is one way how you could get money at a lower cost for the very interesting projects you have for the Indian economy. Now, keep in the backdrop a few things in mind that, well, you know, the Indian economy, we just learned a couple of days ago, is growing at a very high pace relative to the rest of the world, despite such so much difficulties in the rest of the world. And you might be thinking, well, maybe the Indian economy is doing great, but you might should be asking the question, as I mentioned in the class, that what could we have done such that we could have even grow even faster. And for that, we need to understand that what opportunities we could exploit by making those opportunities into giving them the its logical end. And for that, we need money to be invested. And now we all know that, well, to raise money in this world, if you want to go and raise money through equities, since equities are or shareholders have a residual claim, they demand much higher premium to be compensated to give you the money, and hence you going through the equity route is costly. Plus, there are so many other costs of raising the equity. What are the other means you could potentially raise that equity capital or the overall capital? And that is obviously comes back to the debt market. And unfortunately, the Indian debt market is still yet to pick up, especially the corporate debt market. We have a very liquid government debt market, but the corporate debt market is yet to pick up to the level where it should have been, given the current level of growth opportunities that is out there in front of the country. And I think that is one of the major impediment for India's growth. And again, going back to the point I was thinking about, had those impediments not been there, how much money we could have raised, which we could have used more efficiently at the proper means, and hence generate even further growth.
Right. And that's definitely, so we also researched about that, and we also got to know that the debt market is not that liquid in India. And maybe like, so coming to the next point so you recently commercial paper sales have dropped in India by a huge margin, and that has caused the cost of capital of commercial papers to increase from 6% to 13%, which is more than double. And so, like, these problems are not getting solved. We can see. What do you think? Is this a new market opportunity for fintech startups to tackle? Like, can they do it, or how they should do about it?
So the commercial paper market is actually a very lucrative area to both from the perspective of the seller as well as from the perspective of the buyer to raise money at lower cost from the perspective of the borrower. Now, of course, this market is kind of probably a little bit concentrated. Depends on how many players are out there to issue those commercial papers. And if for some reason, if there is a change in the market structure, that does affect how many papers are actually issued, and then that in turn affects, if there is not enough supply of commercial papers out there, that potentially raises, given the level of demand, raises the underlying interest rate that the borrowers are eventually going to be paid. Of course, that's a huge cost, and adds, again, going back to your previous question, adds to the cost of capital, and hence acts as an impediment. Now, here is, of course, and everywhere, not only just India, everywhere people are thinking about that. How could we generate more borrowing being happening through either various other players, because the traditional players may not be equipped, or they may be constrained by, for various legal and regulatory as well as other reasons, to be able to come and supply the capital to the rest of the borrowers. And then hence we kind of have a group of borrowers in the uh, corporate market are kind of being left out, or even the current borrowers are paying too high an interest rate, which kind of raises the cost of capital. And this is where the fintechs could potentially come in. The reason I might think about that fintechs could potentially come in is that the fin and the tech part together could bring out various alternative channels through which they could evaluate the creditworthiness, and hence they would be able to generate kind of a win-win situation, lead to a win-win situation where they could lend at a better rate, uh, uh, and but still remain profitable. So that's the part. It's not that they want to go out of the business and give loan at a loss, but they could still remain profitable, and that's a huge market. So this is where fintech lending part is a lot relevant in this corporate market.
So you talked about like using alternative data and how fintechs can leverage that. So you also talked about it in class. So what actually helped fintechs, what enabled fintechs to use this data and how to generate?
So first of all, to address that question, we have to understand what is alternative data and why there may be a value in terms of evaluating the creditworthiness of the firms. Now, you want to see that, and I gave a couple of examples, especially for lending for the consumer lending space. It has been well documented that alternative data, like what kind of social connections you have, what kind of uh, apps you are kind of currently using, what uh, what is your location, and so many other information, may be highly predictive of your credit risk, better than some stale measure, like if you want to just look at the credit score. Now, why they are better measure? Because they are probably, first of all, more relevant, as well as there are other dimensions of your own persona, which is better predictability of the credit risk. Now, here, of course, there are regulatory restrictions about how could the traditional lender use many of this type of data, and hence they are not being utilized that well. We currently have the new law coming with the privacy of various different parts of individuals, as well as we can think about the same thing for the corporates. So if I talk about the individual borrowers, if we can still keep the privacy concerns in mind, and net of that privacy concerns, we may still have enough information that individuals can be leaving through their digital footprints, which could be better predictive power of their creditworthiness, through which the fintechs, for example, can use that and come up and give that loan. For example, today itself, I was reading in the Economic Times that the lending market is actually one of the major growth market going to be for the fintech firms, and that's definitely true for the individual borrower, consumer level lending, but also true. You can think about the same idea potentially go through for corporates. For example, I'll just give you one example where you can potentially understand the one of the reason that you want to, before you want to lend to Corporate is that you want to make sure that you get enough return back, which means you need to know its consumer base better. Now, as for a bank, who is, if you're sitting like a traditional way in the bank and you are lending to a particular firm, it's very difficult sometimes to evaluate where are the sales coming from. However, for example, I'm going to talk about some Western countries where you have a lot of sales are being digitized. And if you have that digital records of sales of any corporate being used in evaluating their credit risk and in much more real time and with the help of the technology, that might be better a predictor of their credit worthiness for any corporates. And that's where the fintechs potentially could come in. And here you can use the big data and machine learning techniques to figure out how we should be evaluating the corporate credit risk and give loan at a lower rate and cover a bigger base, and hence it's again becomes a win-win situation. We still have higher profitability, lower cost of capital, and now you know the cycle that this potential.
It basically helps the economy at a great level. And so basically, when someone lends to a corporate, they look at the valuations of the corporate and how they are doing. And pretty much, so corporates are old institutions, like they have been here for some time. So their valuation is still pretty easy to do. But for startups, it's pretty difficult, and sometimes they get undervalued, and it's very difficult for an investor or even a debtor to issue debt to a startup. So, how do you think like startups need to value themselves, or do traditional methods like DCF valuation fall short of?
So it's an important impediment and problem for the startups, and given the level of the Indian economy, and I'm so happy that the way the startup ecosystem is kind of growing up over the last couple of years, and we probably have seen an inflection point, and we're growing very fast on that ecosystem. But one of the major problems of any startup is that it's very difficult to show them any cash flow yet. Now, if you are using the traditional techniques like discounted cash flow, where you use your past cash flow to, and then you use some kind of techniques to project the future, and then different parts of the cash flow, and then you use a discounted value model to figure out what's the potential value going to be. So that's a very useful technique, of course, for firms which are well established, where these predictions are much easier to do. But for startups, this is not going to work, specifically for the reason you do not have enough history of previous cash flow. Plus, you are in a new environment or a new industry or a gig economy where you really have a lot of uncertainty ahead of you, and you really do not know which way the economy is going to turn out to be, and hence how the business is going to turn out to be. Now, here the staging of your various investment projects over time is important, and the fact that you have this option of staging various investments over time, once you have got the uncertainties resolved, that has some value implications when you are actually doing the valuations. Now, all these things are not going to show up in your, if you are doing a discounted cash flow valuation. Why? Because in the discounted cash flow valuation, you are doing an expected future cash flow, assuming that you are going to follow no matter what is going to happen to the rest of the economy, which is not true, because especially in a startup and a growing economy, once the uncertainty gets resolved, you start a few things. And I gave you the example of Tesla, for example, the supercharger network. It was previously just for the Tesla consumers right now. Now you just saw that in the US, it is currently being opened up to the rest of the EV market, which is definitely a lot much added value to the Tesla company itself. But think about in a discounted cash flow part, if this uncertainty was not resolved 5 years ago, that what would be the demand for EVs, how many superchargers you are going to need, and you wouldn't be able to value this 5 years before, right? So here you have this uncertainty being resolved that, well, will there be enough demand? Yes. Now, once we are on that growth path of the economy, then we figure out that, well, now I should exercise the option of opening up this supercharging network to the rest of the other EV companies, which is actually valuation to you. Now, this staging of the investments and opening this up actually has a valuation implications for the company. Even for Tesla, it was there for 5 years ago. And you can think about for startups, it is many such examples are true. And this valuation techniques, we call it real options technique. That you have an option to exercise some rights, but you have the right to exercise it, but no obligations. And that has some non-zero positive implications on the valuations to you today.
Yeah, that pretty much actually applies to Ola also in India. When they launched Ola Electric, they first started putting up branches, selling more, and getting their manufacturing in order. And now they executed the option now to put a bigger manufacturing plant in Tamil Nadu. So I guess that's how they gauged the uncertainty part first, and that's how they valued
the valuation. It has a strong valuation implication, which has two things. One, it does affect the valuations of the company that you are talking about, and B, it makes you as a corporate fund CFO of the company, as a manager, that, well, I should be staging my investments in such a project and not commit right now of doing everything, and stage it in such a way that it is the least costly for me to implement and most efficient and valuable for the company and the underlying project as a whole. And that real option way of treating them is the way to
So
go.
these are like the call options which you talked about, and even you talked in class. We have put options
The
where
abandonment.
we can abandon a project if it's not working out. So
Right.
that way also
We can have the
startups
growth
can
option. We
move
can have the
fast.
timing option. When do you
Exactly.
want to do? And then we talked about their interdependent options, where you want to stage one project, part of the project first. You actually should like to start the project, which is as more risky in terms of that you want to do first if things are interdependent, because you do not want to spend money on anything else unless you are really figured out that, well, that the hardest part actually is resolved and answered. And if that uncertainty is resolved, then you put money elsewhere. So this kind of has, of course, managerial implication, because you are making efficient managerial decision. But the fact that you can do that has valuation implication, because you can actually show that the company's value is actually better, because instead of committing everything right now. And that's the main difference between.
That was, I think, the difficult part for Ola also. Like capturing market share was the most difficult part, and that they did that first. And now they are building up their supply so that they can even generate more demand. So that's definitely much important. And thank you for letting us know that. And so, since talking about startups and the Indian economy is doing good, and we recently talked about a Bain Capital report where India, the investments in India are pretty much less in VC by VCs as compared to the Western countries. So, what do you think? How role of startups will evolve, and how startups will take the Indian economy to $5 trillion?
So they have the huge role to be played. First of all, I'm very happy to see the Indian economy in a stage where a lot of individuals are thinking of taking the risk of doing a startup and take themselves as well as the country to the next level of growth. Now, and we have. Last couple of years, we probably have seen the inflection point. We kind of moving to the upward part. Now we have to think carefully here, and here is the previous first question to you: is the cost of capital comes into the picture? That, well, this can only be sustained if there is enough funding available, right? So then, of course, venture capitals are one source of funding the startups, but the traditional venture capitalism probably has to evolve, and private equity industry has to evolve. It has evolved in the US and still evolving in the age of the new technology and use of the big data and machine learning. And we touched upon a little bit that how can we generate and evaluate the startups and the firms better with alternative data and machine learning techniques, so that as a VC, I can actually give out money to the rest. And again, the money does not have to be, the advantage is that the VC funding should not happen just from the Indian origin VCs. Now, a lot of the US and the rest of the world money is coming into India through maybe part of that through the VC industry. Because they see the growth potential in India. So, and given the more highly integrated world economy, global economy, this is going to continue. So, it's our job to make sure that we kind of evolve in the VC industry and use new technologies to be able to evaluate the startups better, perhaps through this alternative data and big data technologies that I think I told you some of my research that I did, and which showed up very highly promising, and had a win-win situation. And that is hopefully going to attract more capital, because that moment you see that the moment you can see that you can evaluate the credit risk better, more money will come in, because you can lend out at a lower rate, at a lower risk, and as well as a lower rate, and that is going to churn out and will start its own cycle to take it to the next level. And that's what we are kind of waiting. So next few years is going to be very interesting and eventful to watch.
As we speak, AMD has launched. AMD has promised $400 million of investment in Bengaluru for their R&D. So, as we know, for ChatGPT and these things, AMD and Nvidia, these are the main suppliers for processing power. So, I guess we are on the right track, but we need to grow even faster. And cost of capital will definitely help us to achieve that faster. Now, coming back, so we talked about a lot of things, like how a treasurer or a CFO, like you mentioned, the role of a CFO, how startups should think. So, what do you think as students of MBA, these industries like investment banking, private equity, venture capital, what sort of new roles are coming into these industries, and how our current knowledge will help us go there? What we are learning at BITSoM?
So I always believe myself to be a lifelong learner, but I still kind of envy you people, because you are in a stage where you have so much opportunities, and the rise of the LLM, large language models, and the rest of the machine learning things kind of showed you that it has created a new set of opportunities for you. And here is the role of this, using the technology and with your business knowledge and combining them together, because many of you have engineering or technical backgrounds and you want to do MBAs at BITSoM, right? So this is the win-win combination you actually have. So you need to. So we talked about fintech, we talked about big data, we talked about startups. This is probably where a lot of tech part knowledge that you already have. But then we also talked about, well, unless you actually bring into your business knowledge efficiently coupled with these two together, you won't be able to go to the next level, because that through that you'll be making better managerial decision, as well as you'll be making better lending decision, as well as better valuation decisions. Now at BITSoM, I'm very happy that you were learning some of these things, because here you are kind of trying to build these things together, and the applications of that is we already talked about consumer and corporate lending, and the fintech market. There is a big market for robo-advising, algorithmic trading, everywhere. All this fintech and machine learning techniques could be potentially used to make the market bigger, and that's where a big role for you and your training at BITSoM should be more valuable.
Yeah, so we should not think finance as more of, what CAs used to do earlier, and then they used to go up the ladder. But even engineers now, if they build the right skills, they can basically go into new avenues like fintech and
Right. So I'll put it in this way. So of course there is a role of everybody in this, and now all the roles are getting highly integrated together, right? So previously this interdisciplinary knowledge probably was not as valuable for what it is today, because you can use your technical knowledge, but just technical knowledge will not let you succeed in the financial world. But you also want to couple it with to understand the business part and the financial part. How should you be doing the valuations, and how you can actually use the technical knowledge to do those valuations. These together is going to give you that edge. And that's why I said I'm envy of you all, because you have the opportunity to do that. So you all can now think about exercise that real options, because that uncertainty has been resolved.
and market will provide us
Market will
better
evaluate you
value
better.
because
Yeah.
we have this knowledge. So I think we can relate finance now with the real options pretty much. Thanks to your class, Professor. And it has been great talking to you. And this has been a great session here. I hope the people who are watching this gain some insights and how they can look at finance in a new way and how they can relate things what are happening in the industry. Thank
Great
you
to
so
be here.
much.
Thank you. Thank you for having me.
Thank
Good
you, sir.
luck.
Thank you.